FICO Score. It is the most widely used credit score in the United States, created by the Fair Isaac Corporation in 1989. Lenders use it to decide whether to approve loans and at what interest rate. The score ranges from 300 to 850, and it is built from 5 factors: payment history, amounts owed, length of credit history, new credit, and credit mix. A score above 670 is generally considered good, while anything above 740 opens the door to better rates. Most mortgage lenders, banks, and credit card companies pull a FICO score before making any decision. VantageScore. This was developed jointly by the 3 major credit bureaus, Equifax, Experian, and TransUnion, and launched in 2006 as a competitor to FICO. It uses the same 300 to 850 range, but weighs factors slightly differently. Total credit usage and credit age carry more combined weight here than in the FICO model. One notable difference is that VantageScore can generate a score with as little as 1 month of credit history, while FICO typically requires at least 6 months. It has become increasingly common among lenders, landlords, and fintech companies. FICO Auto Score. It is a version of the FICO model designed specifically for car loans. Standard FICO scores look at credit broadly, but the auto score places heavier emphasis on how a person has handled past auto loans. If someone missed payments on a car loan years ago, that history will pull this score down more than it would affect a general FICO score. It also runs on a wider scale from 250 to 900. Dealerships and auto lenders are the primary users, and most consumers never see this number unless they specifically request it. FICO Bankcard Score. This works the same way as the auto score, but is tailored to credit card lending. It focuses more closely on how applicants manage revolving credit. Things like how often they carry a balance, how close they are to their credit limits, and whether they have a history of late payments on existing cards. The range is again 250 to 900. Card issuers use it to screen new applications and sometimes to review existing cardholders when deciding whether to raise or lower a credit limit. FICO Mortgage Score. Before approving a home loan, most mortgage lenders pull this specialized version of the FICO model. It puts extra weight on mortgage payment history and any past foreclosures or serious delinquencies related to housing debt. Because buying a home is typically the largest financial transaction a person will make, lenders want a score that reflects housing-related risk as precisely as possible. Under federal guidelines for conventional loans, lenders are often required to pull scores from all 3 bureaus and use the middle score for qualification purposes. NextGen Score. It is a lesser-known FICO product designed to evaluate consumers who are harder to score with the standard model, people with thin credit files, short histories, or unusual credit patterns. Fair Isaac developed it to extend creditworthiness assessments to a broader population without lowering lending standards. It uses a scale of 150 to 950 and considers some behavioral patterns not included in the classic model. Adoption has been slower than FICO's mainstream products, but it appears in certain specialized lending contexts. ChexSystems Score. This one has nothing to do with loans or credit cards in the traditional sense. It is used by banks and credit unions when someone applies to open a checking or savings account. ChexSystems collects data on banking behavior: overdrafts, bounce checks, accounts closed for misuse, and unpaid bank fees. The score runs from 100 to 899, and a low score can result in being denied a basic bank account. Many people are unaware this system exists until they are turned away at a branch. It operates under the Fair Credit Reporting Act, so consumers have the right to request their report. Insurance Credit Score. Insurance companies in most states use a version of credit scoring to help set premiums for auto and home insurance. The logic behind it is that research has shown a statistical correlation between credit behavior and the likelihood of filing a claim. This score is not identical to a lending credit score. It is recalibrated to predict insurance risk rather than loan repayment. Some states have restricted or banned its use, arguing it creates unfair barriers. For most people, a stronger credit profile tends to result in lower insurance premiums, sometimes by a significant margin. Business Credit Score. When a company applies for a business loan, a line of credit, or trade terms with a supplier, lenders and vendors check a business credit score rather than a personal one. The most recognized provider is Dun & Bradstreet, which issues a PAYDEX score ranging from 0 to 100, based entirely on whether a business pays its bills on time. Experian and Equifax also maintain business credit files. A business starts building its own credit profile as soon as it registers with the relevant agencies, though many small business owners are unaware their company has a separate credit identity at all.